If you ever wanted to pay less in taxes legally, chances are you did not know where to start. And that is not your fault. Today, I am going to walk you through 4.5 tax principles that explain how taxes actually work and why high-income earners often overpay without realizing it. But first, you need to understand how the system actually works. A few years ago, a client told me that he was thinking of turning down a raise because he believed it would push him into a higher tax bracket and cost them more money. That is one of the biggest misunderstandings I see. When most people earn income, the process looks like this. You get paid, you pay taxes, you spend what is left. In the United States, we have a progressive tax system with marginal tax brackets. That means that higher income is taxed at a higher rate, but not all your income is taxed at the same rate. Think of tax brackets like a row of buckets. You start filling the first bucket, then the second, then the third. And each bucket has its own tax rate. So if you earn $60,000 in taxable income, you do not pay 22% on all of it, only the portion that spills into that tax bracket. Understanding this alone clears up a lot of confusion. Here's the real secret most people miss. You could technically earn $100,000 and only pay taxes on $60,000. The difference is taxable income. And lowering taxable income is not about tricks, it is about strategy. But to do that, you have to change when income becomes taxable. The first way to cut your taxable income is through qualified retirement plans. Most people are familiar with the 401k. A 401k allows you to contribute pre-tax dollars, lowering your taxable income while investing in your future. You can contribute more than $24,000 per year. If you're over 50, you can contribute even more. And if you're in your early 60s, the limit climbs higher still. Some employers match contributions, which is even free money. The trade-off is that the IRS restricts access to those funds until later in life, although there are exceptions for life events. There are also other tools that people overlook. HSA accounts, which reduce taxable income while covering medical expenses. Traditional IRS, which are tax deductible and offer tax deferral. 457B available to certain organizations and professionals. And last but not least, cash benefit plans that allow you to fund up to $250,000 a year. We currently have a client that is funding $575,000 a year, all tax deductible. Now, here's where high income earners gain leverage. Instead of get paid, pay taxes, spend money, they structure things as get paid, spend strategically, pay taxes. This is possible because the tax code favors business owners, investors, and entrepreneurs, people that earn income outside a traditional W-2 job. When I first started earning income outside a traditional job, I was overwhelmed. I was stressed. I did not want to screw up. I did not want to make a mistake, and I did not want issues with the IRS. That's when I learned two key principles that changed everything. Business owners and independent sole proprietorship, business owners can use tools like a 401k. This allows higher contributions than a traditional employee plan, often thousands per year, reducing income even further. Then there are legitimate business deductions. If you work from home, portions of your home may qualify. Business meals, education, equipment and depreciation, when structured correctly, all reduce taxable income. The key word here is correctly. This is where strategy matters. Another area where the tax system works differently is investment income. Long-term capital gains are taxed differently than earned income. Holding investments longer than 1 year can significantly reduce taxes, and in certain situations, even reduce them to zero. This is why high-income individuals rely heavily on long-term investment, not short-term speculation. Why the wealthy pay less legally? Most high net worth individuals do not rely on salaries. They earn income through investments, real estate, and businesses. That gives them control over timing, structure, and taxation. It's not about avoiding taxes. It is about designing strategy before the income hits. It's strategy 4.5, using debt strategically. The final concept that many people misunderstand is debt. When used irresponsibly, debt is dangerous. But when structured correctly, it becomes a very powerful tool. Wealthy individuals often borrow against their assets instead of selling them, allowing access to capital without triggering taxes. This comes with risk and must be structured correctly. But it's another example how strategy changes outcomes. If this feels complex, that's because it is. And that's why strategy matters. The biggest mistake high income earners is waiting until April to ask questions. I have spent over 30 years helping business owners understand this. Trained at Deloitte, trained at PwC, Big Four standards. On average, my clients save over $125,000 per year, not through tricks, through structure. If you're a business owner and investor earning between $1 million and $10 million per year, and you want to understand how these principles apply to your situation, the next step is simple. Click the link below and schedule a strategic tax assessment. No pressure, no tricks, just clarity. Some CPAs file, we plan. You got this.